cover the latest global and domestic economic financial development, and then certainly conclude with the decision taken by the MPC today. So on the global front, the global economy remained resilient, with growth holding rather steady and inflation gradually falling towards target, notwithstanding the still high interest rate environment and ongoing geopolitical tensions. In its April 2024 World Economic Outlook, the IMF has projected global growth at 3.2% for this year and forecast the global economy to grow at the same pace for next year also. Divergences across major economies were noted in the first quarter of this year, with a slowdown in the US economy and gradual recovery in the euro area and the UK also. The economy in China was supported with stronger growth in its high-tech manufacturing sector, notwithstanding the persistent woes in its property sector, while growing slowdown, were also recorded. But nevertheless, it remains very robust. Leading economic indicators, notably the Purchasing Managers' Indices, the PMI, pointed towards continued expansion of economic activity at the start of quarter 2 of this year, albeit at a slower pace. The JP Morgan Global Composite Output Index fell to 52.9 in June 2024 from 53.7 in May 2024, and reflected lower expansion across both services and the manufacturing sectors. Inflation has continued to fall as a result of the effects of past monetary policy tightening, together with favorable commodity prices as well. The IMF, in its April 2024 World Economic Outlook, forecasts global inflation to fall from 6.8% in 2023 to 5.9% in 2024, and further to 4.5% in 2025. Going forward, inflation is expected to be largely driven by a broad-based decline in global core inflation on the back of softening labor market conditions and the effects of still tight monetary policies. Oil prices, while maintained an increasing trend since beginning of this year, declined in May, reflecting mostly weak fuel demand and a pile-up in inventories in the US primarily. Global food prices have maintained their uptrend since April 2024, mainly due to growing concerns about unfavorable crop conditions for this year's harvest. Freight cost, as gauged by the Global Freighters Baltic Index, surged more than 100% since April this year, as a result of acute space shortages, longer transit times, rising insurance and fuel costs due to the continuing attacks on ships in the Red Sea area. The global monetary policy cycle has already switched to a dovish stance, you would have noted, and is more concentrated in emerging markets rather than in advanced economies. The European Central Bank, the ECB, lowered its key policy rate by 25 basis points to 4.25% at its June 2024 meeting, reflecting largely weakening price pressures as well as an improved inflation outlook. The US Fed and the Bank of England are likely to start cutting, most probably as from quarter 3 of this year. Since the beginning of the year, out of 250 MPC decisions taken globally, 156 decisions have been to leave policy rate unchanged, while 74 decisions have been to cut policy rates and 20 decisions have been to increase policy rates, thus providing evidence that this proclivity to cut rates has become a bit more entrenched now. On the domestic front, After having registered 7% GDP growth in 2023, the domestic economy sustained its growth momentum, expanding by 6.4% in Q1 this year. The accommodation and food services activities, construction and financial and insurance activities sectors remained the locomotives of growth. On the expenditure side, growth was mainly driven by investment spending on major capital projects amidst the ongoing construction boom. The resilience in final consumption expenditure also persisted, underpinned by higher household spending. The tourism sector remains a fulcrum for the strong GDP growth, mostly on account of upbeat demand for travel and tourism and effective promotional efforts. Tourist arrivals reached 635,324 for the period January to June 2024, which represented a recovery rate of 97.7% over the 2019 level. After reaching a high of nearly 86 billion rupees in 2023, tourism earnings look well set to clinch new records this year, aggregating 38.9 billion rupees over the period January to May 2024 only, representing here again an increase of 8.6% compared to the same period last year. Tourism earnings are thus projected to reach a new record high in 2024. Prospects for the tourism sector look promising for the rest of the year also. Sustained demand for holiday travel, improved flight connectivity, and concerted efforts to extend our market reach beyond traditional source destinations will be key ingredients to achieve the expected mark of 1.4 million tourists for this year. The labor market remained resilient in Q1 2024. Broad-based momentum in the different sectors of the economy underpinned strong demand for labor, alongside positive impetus from labor market policies. The unemployment rate, at its lowest for the past 27 years, stood at 6.3% in Q1 of this year, after dropping to 6.1% in Q4 of 2023. Interestingly, youth and female unemployment rates both decreasing thanks to the implementation of targeted employment measures stood at 18.9% and 8.7% respectively. In Q1 this year, it is worth mentioning that female participation rate has reached a new high of 48.5%. This provides encouraging signs that female workers continue to move back into our labor force with the ongoing pro-female employment incentives such as la prime à l'emploi. Looking ahead, labor market prospects remain promising. Sustained growth in important sectors will likely encourage new demand for workers and support job creations. Government policy measures, including streamlined foreign labor policy, training and wage subsidies, are helping to address some recurring labor market issues. The current account deficit as a ratio of GDP narrowed to 4.5% last year, mostly reflecting the robust performance of the services and net income accounts. The current account deficit is projected to decline further to around 4% of GDP this year. Sustained dynamism in the tourism sector will benefit the services account, while the surplus on the primary income account will remain supported by elevated global interest rates. The Mauritius International Financial Center continues to attract healthy financial flows as global cross-border investment activities remain resilient despite challenging global conditions brought about by the ongoing Russia-Ukraine war, high global interest rates, and heightened tension in the Middle East. With respect to the non-GBC flows, the country registered record high gross foreign direct investment flows in 2022 and 2023. Directly, from many key sectors, mainly real estate activities and accommodation and food services linked sectors. For this year, that is for 2024, as well, buoyant FDI flows are expected to be sustained, reaching a record high of 40 billion rupees. The gross official international reserves, our GOIR of the country, remain at very comfortable levels, providing adequate buffers against potential external shocks as well. The GOIR stood at $8.2 billion as at the end of June this year, representing 12.9 months of import cover. Compared to June 2023, the GOIR at end June 2024 were higher by $1.5 billion. On the inflation front, recent price dynamics point towards a continued easing of domestic inflationary pressures on the back of stabilizing global oil prices, receding trading partner inflation, lasting effects of monetary policy tightening, and fiscal-driven favorable price shocks. Headline inflation declined to 4.5% in June 2024, moving within the inflation target range of 2 to 5%. Year-on-year inflation also remained entrenched on a downward trajectory, falling to 2.2%, reflecting a gradual normalization in the prices of fresh vegetables. Core measures of inflation, which provide a better assessment of underlying demand pressures by controlling for volatile energy and food components and help to distinguish between transitory and permanent inflationary impulses, continued to subside as well. Year-on-year Core 1 inflation, that excludes the price effects of food items, maintained a downward trend till May 2024. Core 2 inflation, which further adjusts the movements in energy and administered prices, was broadly stable. A more detailed scrutiny reveals that the proportion of pro-inflation items in the CPI basket has been consistently shrinking. Essentially, items that were deemed as highly inflationary, that is, those items that were generating above target range inflation of more than 5%, plummeted from nearly 62% in June 2023 to around 23% in June 2024. In contrast, items that were deflationary, that is, those having less than 0% inflation, increased to around 40%. These dynamics provide concrete evidence that inflation is steadily moving towards the bank's midpoint target for inflation of 3.5%. On the money market front, the bank maintained its open market operations to manage the rupee excess liquidity prevailing in the banking system. With a view of mopping up structural excess liquidity, the bank resorted to longer-term operations, such as provided under the new monetary policy framework, which we have implemented, as you know, since January last year, and issued BOM bills for an aggregate amount of 30.5 billion rupees in the 91-day, 182-day, and the 364-day tenors between the 3rd of April and 28th of June this year. While being the main instrument for monetary operations, the 7-day bond bills are issued on a weekly basis at the key rate of 4.50%. Banks continue to avail of the overnight deposit facility at the rate of 3%. On average, an amount of 29 billion rupees was placed with the bank on a daily basis over the period 3rd April to 28th of June 2024. The rupee excess liquidity was contained at a daily average of 2.8 billion rupees over the same period. Consequently, the outstanding amount of bond securities issued to manage excess liquidity increased to 150.3 billion rupees as at the end of June 2024, from 139.2 billion rupees as at the 3rd of April 2024. More than 50% of the securities are short-term tenors and they will be maturing within a one-year period. The weighted average overnight interbank rate hovered closer to the lower bound of the interest rate corridor, ranging between 3.10% and 3.20% since the last MPC. On the foreign exchange market, the domestic foreign exchange market remained driven by the high volume of transactions with the financial sector, importers of goods as well as tourism operators. From the 3rd April of this year to the 28th of June this year, FX turnover stood at $3.1 billion and net purchases of $127 million were registered as well. The rupee continues to reflect key economic fundamentals of demand and supply, as well as international currency movements. You would have noted that the bank intervened on the market on this Monday the 8th of July, and we sold $50 million at 46.76, which is the market determined rate. As we draw closer to the end of year orders, I wish to reassure the market that the Banque de Maurice will closely monitor the situation and that we stand ready to intervene to ensure orderly supply of foreign exchange and foreign currency on the market as and when needed. The bank will closely monitor the situation, and as I say, we stand ready to intervene as and when required. I'll now turn to financial stability updates by sharing with you some of the key developments on the soundness of the banking and the financial system of our country. I must reiterate that a sound and stable financial system supports the achievement of price stability and vice versa. Monetary policy is transmitted to the economy through the financial system, and to enhance the effectiveness of monetary policy, a stable financial system is certainly a very important prerequisite. Macro-financial conditions have continued to improve with disinflation and buoyant economic activities. As a result, risk to financial stability have receded further since the beginning of this year. The systemic risk indicator, which tracks the evolution of systemic risk in the financial system, indicates a sustained decline in vulnerabilities over the past 12 months. The decline in inflation has greatly contributed to lessening macro-financial risk. Banking sector vulnerabilities remain low as the risk absorption capacity of banks was strong, supported by robust capital and liquidity buffers. Risk from the household and corporate sectors have been well contained as well. Still, risk from the external environment was elevated with a high degree of uncertainty. Household sector vulnerabilities continued to decline with improved financial soundness and slower credit growth. Debt serviceability metrics such as the debt service cost to GDP and income progressed positively in the first quarter of 2024, demonstrating sustained debt servicing capacity of households. Debt sustainability risk from the household sector, measured by the leverage position of household relative to GDP, remained firmly on a downward trajectory as well. Risk of debt service stress from household stayed low. This is reflected in the quality of banks' household credit portfolio, with the non-performing loans ratio at a low level of 1.9% in March this year. Financial stability risk from the corporate sector remained low as well. Corporate leverage relative to GDP declined further in March 2024 and was below pre-pandemic levels. The economy was well supported by the steady flow of credit from the banking sector. Bank credit to the private sector registered an annual growth of 7.4% in May this year, driven mainly by growth in credit extended to the household sector. Household credit expanded by 11.5% in May 2024. Similarly, bank credit to the corporate sector grew at an average rate of 4.4% in May 2024. The asset quality of the banking sector remained broadly sound, maintaining credit risk at manageable levels. The NPL ratio of the banking sector was 4% in March 2024, slightly up by 0.1 percentage point from the last quarter of 2023. Banks set aside adequate provision against NPLs. The coverage ratio was 53.1% in March 2024. The resilience of the banking sector was supported by strong capital and liquidity buffers. The capital adequacy ratio, the CAR as we know it, of the banking sector rose to 21.2% in March 2024, staying well above the regulatory limit inclusive of the capital conservation buffer. The liquidity buffers maintained by banks, both in rupees and major foreign currencies, were assessed to be adequate to mitigate liquidity risk. The liquidity coverage ratio, the LCR, was above the regulatory floor of 100%. The aggregate LCR was 309.4% in March this year, and the LCR for material foreign currencies stood at 227%, again in very comfortable zones. The banking sector's degree of vulnerability receded and its resilience strengthened further in the first half of 2024. The stress test exercise revealed that the banking sector is resilient to a series of exogenous macroeconomic and idiosyncratic shocks. As the domestic economy paves its way on solid ground, banks were expected to consolidate their buffers, providing additional headroom to absorb any materialization of shocks. The Banque de Maurice continues to monitor risk to financial stability while ensuring price stability. I will now shift the focus to the decision and the discussions of the MPC held today and briefly explain the rationale behind the decision that we have reached today. A common theme facing central banks globally is that we are standing at a very important crossroad with two main future pathways for monetary policy making. Either keeping the current monetary policy stance on hold until more concrete signs of cooling activity become evident, but at the same time running the risk of stifling the economy for a little longer than is necessary, or is it time already to start delivering on interest rate cuts? But again, at the risk of letting the economy run hot earlier than is necessary. The most optimal approach for deciding on the future of monetary policy is to have a data-driven assessment of the state of the economy, looking at the incoming data for main macroeconomic variables and combining with projections and risk and outlooks. Hence, as is the usual practice, before coming to its decision, the MPC carefully reviews developments occurring on the domestic and international fronts and assesses their broad macroeconomic implications, specifically for our local and domestic context. Recent inflation data provides encouraging signs that the disinflationary process remains ongoing and is very much likely to pursue in the second half of this year. Some favorable domestic factors are enabling a more rapid deceleration in inflation, which include a faster than expected normalization in local food prices, announced a reduction in LPG prices, and extension of subsidies on basic necessities which were provided in the recent budget. Moreover, latest commodity price developments and inflation readings for main trading partner countries are supportive of lower price pressures domestically as well. It is worth reiterating that the current monetary policy stance continues to exert restrictive effects on the economy and is maintaining a lid on underlying price pressures under check, while keeping inflation expectations well anchored. There is thus growing confidence that inflation will become firmly entrenched within the bank's target range for inflation, which has been defined as being between 2 to 5%. Barring any shocks, headline inflation is forecast to close 2024 at 4.9%. With regard to the growth outlook, it is expected that the domestic economy will sustain its robust momentum. Bank staff maintains the projection for real GDP growth at 6.5% for this year. The construction, accommodation, and food service activities, as well as the financial and insurance activities sectors, shall be the main engines of growth. Backed by ongoing large-scale infrastructure projects, the construction sector will maintain an impressive performance with double-digit growth rate. As already mentioned, the tourism sector will hold its way as an important growth driver as well, given expectations of 1.4 million tourists visiting us this year. Growth momentum in the financial sector will also persist, with concerted efforts being devoted towards cementing further the international reputation of the Mauritius International Financial Center. Aggregate demand will be supported by increasing household consumption and buoyant investment expenditure amidst decisive policy support, growing optimism over economic prospects, and ongoing infrastructure development. The expected trajectories for growth and inflation and the balance of risk to these outlooks provide the MPC with comfort that the current monetary policy stance therefore remains appropriate for promoting conducive macroeconomic conditions in our country. The MPC therefore decided unanimously today to keep the key rate unchanged at 4.5%. The MPC will continue, certainly, to monitor the economic situation closely and stands ready to meet in between its regular meetings if the need arises. The next meeting of the MPC would be announced in due course. This, dear friends, brings me to the end of my intervention, and I'd be pleased to take on a couple of questions. Yes, Kamlesh, I see your hand up.
Good, sir. Thanks for the explanations regarding the MPC and the FX. Yet, we see that the rupee is showing signs of much volatility, and there are calls for more intervention from the central bank. So, first question, what is driving this volatility of the rupee? Or is there a scarcity, big shortage of dollars in the market, and what are the reasons? Are some companies holding on their dollars, expecting the rupee to depreciate further down? And how much firepower, as we usually ask, the central bank has to intervene?
Okay, thank you. Look, the fact of the matter remains that when you look at the trajectory of the rupee, it continues to reflect economic fundamentals in the country. And you would have noted that the Bank of Mauritius, we intervene for two reasons. One is to comfort the market in terms of supply of FX, and certainly our second reason from time to time is to also control excess volatility. We should not forget that we have a floating system of the currency, so therefore market must do its job. Demand and supply must do its job. At the level of the Banque de Maurice, we continue to watch this space very, very closely. And if we feel there's a need to intervene to control any of these two factors, we do so. The intervention that we did this Monday was to further comfort the market in terms of FX availability. Why? Because we are reaching, and I said it in my statement, we are reaching that point in time when most of the importers start, ordering for end of year supplies, and therefore the demand for FX is naturally growing on the market, and therefore this is what explains why we intervened. Now, with the work that we continue to do, we will continue to monitor the situation, and I will continue to intervene if we feel that we need to intervene. But certainly, rest assured that the Banque de Maurice is not out of firepower. I just mentioned to you that we closed our GOIR, our gross official international reserves, at $8.2 billion already, which is very comforting. And it also means that the Banque de Maurice has enough of firepower to supply the market if it needs to supply, and also control any excessive volatility if we feel there is any excessive volatility coming our way.
You're talking of you're supplying the market, that's a good thing. But do you have any instrument, financial instrument, to see whether forex pro-use either by tourism industry or whatever financial services are really coming to Mauritius? Do we have? Are they really coming?
No, sure. I mean, this is something we watch on a daily basis again. I mean, look, on a daily basis, look, we are the only one in the country to have that dashboard to see how forex activities are performing in the country. And I must tell you that, be it in the financial sector or be it in the tourism industry, hotels have been selling on the market, certainly. So it is functioning. The market is functioning, and this is what explains as to why we did not have to intervene in significant amounts since the beginning of the year also. But as I say, now we are reaching that period, as was the case last year also, if you would recall. We had to intervene a bit because we are approaching those end of year orders, and this is the time when you have to pay for those end of year orders.
One final question regarding the FX. Is it time, or is the central bank considering the option of not controlling, but to have a better understanding of how much hard currency is in circulation in the country, and how much is getting in and how much is getting out? Or is there such a mechanism already in place?
I know we already have such mechanisms. I mean, that's why I say we are the only institution in the country which has that perfect dashboard view, that overview. I mean, this is something that we do. We've got a specific department. There's a specific directorate within the Banque de Maurice that monitors this on a daily basis.
Regarding how
to tell you, yeah, sure. So basically, we've got the proper breakdown. We've got the complete view of how things are being done. But certainly, we are in a country where there's no exchange control. We should not forget this also. And this is one of the most important, I would say, benefits and advantage of Mauritius when it comes to investments also. So yeah, definitely we have that broader perspective already in place.
It has been said that part of the reserve that you're talking about is made up of loan. What's the part of loans foreign?
Look, you need to understand the functioning of central banks. All central banks, we do enter into various financial arrangements with other central banks. We do it bilaterally. There are swap lines, there are lines of credits that exist between various central banks, and this is common. Among all central banks, you do it. Certainly, central banks do not publish these details because these are pertaining to the affairs of those central banks. But this is common practice. And as has been the case always, the Banque de Maurice, We have resorted to a number of avenues also, especially during the time when the country, we should not forget, was going through the COVID period. So we did engage into a certain financial arrangements with other central banks and other commercial banks also. And as I said, this is normal practice. There's nothing strange or that should not be done. All central banks do them. Yeah.
Recently, the central bank intervened in the market with $50 million. And however, there are some importers are claiming that there's still a lack of foreign currency to do their day-to-day business. So what is the problem?
No, that's why I said, look, we monitor the situation closely. I intervened on Monday. Doesn't mean that this would be the only intervention. As I said, we stand ready to intervene for how long as it is necessary. We did that during COVID. And we have more firepower now, I would say. So if we need to intervene, we will be intervening, but we'll be also watching the market conditions very, very closely. What is important is to ensure that markets operate in an orderly manner. And this is one of the responsibilities that we have also. So we will continue to watch, and if we feel that we need to intervene, we will be intervening more, definitely.
And the bank also came forward with saying that we will come with a guideline concerning the forward rate. So the discussion also will be.
We are in consultation modes. We've been discussing with treasurers and the CEOs of banks also. So these are things that we are currently consulting with the industry. We would be certainly continuing those discussions to see what would be the best win-win sort of like solution that can be brought onto the table.
So there will be guidelines?
Many central banks have put it around the world, and we are reflecting on that also. We have started work already. Work is already ongoing on that, and but it will be a process. We need to consult. We need to make sure that it works, and it works in such a way that it does not create distortions onto the good functioning of the forex market.
One of the MPC meetings, you announced that you are making sure that the rate of exchange of the rupee doesn't exceed, I suppose, as far as I remember, 46 or 47, as far as I remember. And those who exceed, you are sanctioned, was announced for. Is this policy still in store?
Look, as I say, the markets have to function. Markets have to function. And I did not say any specific figure. What I said that is we will always come in to ensure that there is no excessive volatility in the way the rupee behaves. And this is what we continue to watch. We are at a point in time where, as I said, the rupee is reflecting economic fundamentals of the country. Markets are doing their work. If we feel that there is excessive volatility, we will intervene to address that issue. But if there is need to sanction, we will sanction. That is our job. We will sanction when we need to sanction. Actually, I remember very well last year, we did not hesitate to sanction banks when we thought that they were behaving not necessarily in the best interest of the market. And we continue to watch all these spaces. And if we feel we need to take that decision, we will be taking the decision. Any other questions? Yeah?
There are some people claiming that they are not able to exchange their old currencies at the banks. So is the Banque de Maurice will intervene on this matter?
All currencies? What do you mean all currencies?
All notes.
Well, if a note is out of circulation, obviously no bank will accept that. Many countries around the world, they have a cycle of their currencies. They change their family of notes. I'll take the case of the UK. They've recently changed their family of notes, and many notes have now become out of circulation. So our banks, the commercial banks here, do not have the right to accept those old notes. So it goes without saying that they will not be accepting old notes. So I'll make an appeal to the population to follow up also what is happening internationally if they are holding on other currencies, and to exchange their currencies when it is still legal tender, and not wait for it to be not legal tender and then try to bring that to exchange. Okay?
Just to follow up, and final question from me. When could we be expecting a new generation of crisp new banknotes, if that's in the pipeline?
You answered it, if that's in the pipeline. As of now, it's not in the pipeline. Okay? Thank you. Thank you so much.
Non, il faut venir avec une pièce d'identité.
Non, correct. C'est ça.
Oh, Forex.